Hello, everyone. Welcome to our presentation for Habitat Homes, Affordable Housing Fund. A little about Habitat Homes. I am Rida Murad, the founder and principal of Habitat Homes. We have been in the business of owning, operating, and managing manufactured housing communities in the United States since 2016. Our previous fund owns 20 manufactured housing communities with 1,292 home sites in 5 different states. Since our inception, we've never missed a quarterly payment. Our annualized quarterly cash distributed yields have been north of 8%. And our last fund currently that was launched in January 2018 is operating at 14% cash yields. And we expect it to return north of 18% IRRs to its fund life. Martin and the Smart Money team, thank you so much for letting us come and present this on your platform. I wanted to quickly go through our offering a little bit for you guys. What we do is we own and operate manufactured housing communities is the cheapest form of home ownership in the United States. The tenants own their own homes, but they do not own the land and the infrastructure. We do. Over 8% of the US population lives in manufactured housing communities. That's nearly 20 million US citizens live in them. So with that backdrop, let me walk you through the presentation. So what do? We create strong short-term cash flows and superior long-term returns through the acquisition, aggregation, and operation of manufactured housing communities across the United States. The focus for this fund is actually the more tax-friendly states where we have demographic inflows, less regulatory burden, and lower cost of living. That includes Florida, Georgia, South Carolina, Tennessee, and North Carolina. Essentially markets where there's population inflows and job growth and cheap cost of living and lower taxes. And also lower burdens from a point of operating these communities. We'll walk you through the macro perspective, a little bit about the communities, what we do, what our details look like for investment, and the benefits of these sites. So, many working Americans' employment does not guarantee a living income. 50% of American workers earn a wage less than $35,000 a year. And 39 million Americans actually live at or below the poverty levels. This is how the economy stacks up right now. If you look at the average home price since 1980, a single family home has gone up an average from $105,000 to over $390,000. At the same time, median household income since 1980 went from $25,000 to only $68,000. As you can see, home prices have multiplied at a rate dramatically beyond what incomes have gone up by. At the same time, people on government assistance has gone up by tenfold, and the number of people in the labor force has shrunk by 3% because of the declining population pyramid. So we are facing an affordable housing crisis in the United States, where more than 37 million people are cost burdened, and more than 17 million people are severely cost burdened, which means they're spending more than 30 or 50% of their gross income on housing costs. Over 63% of Americans live paycheck to paycheck, and coronavirus has made this dramatically worse. We are seeing prices of goods dramatically rise in the US, with inflation at 5.4% in the last 12 months. And we see this clearly going the wrong direction. If you look at this chart here on page 10, it'll show you that the cost of goods is increasing the fastest pace. And if you look at the bottom 6 categories, these are the categories that are actually the most impacting to people on an affordable price point. Gasoline to travel to work, used cars, which is what the affordable segment of the population use, uh, gas for heating and piping, and basic foods, meat, fish, poultry, and then electricity. They're all growing at a dramatic pace. So the demand for affordable housing is growing. Millions are experiencing hardship because of long-term unemployment. They're facing evictions due to difficulty in making rent payments, and also technological changes that are creating job losses through automation are playing a direct role in. What are MHCs? MHCs are a very important part of the US housing stack. This is where the workforce housing primarily live. These are homes that are manufactured in factories and then are shipped to the site. The homeowner does not generally own the site. We do, hence the manufacturing housing community ownership. This is singularly the cheapest form of home ownership solution to the US population. They still get the pride of home ownership where they upkeep it, manage it, but they do not own the land. And as a result, their affordability goes up dramatically. The MHC section, manufactured housing, costs less than half per square foot to be built. This slide kind of walks you through the cost of building an average single family home in the US versus the cost of manufactured housing. The blue line is for single wide homes that are smaller, and then the double wide homes are 2 single wide homes essentially that essentially make up to 2,400 square foot of living space. So they've gone up single wides from $45,000 to $57,000 over the last 6 years, and double wide 82 to 108. Small inflation for sure, but single family homes at the same time, cost has gone up from $288,000 to $336,000 to be built. Dramatic rise. As we said, over 20 million people live in manufactured housing communities in the US already. There are 54,000 communities in the US. It's declining, and over the last decade, only 100 new communities have been built. Multiple reasons why it doesn't get built and approved: because of NIMBYism, because of challenges for zoning, and because of the stigma around the word trailer parks. We've just not seen a rise in this thing. There are 7 million occupied manufactured homes in the United States, within which 20 million people live, as we mentioned earlier. If you look across the ownership of manufactured housing by state, you will see that a very big chunk of various states' population actually lives in these manufactured homes. Florida is a big one, North Carolina, Texas, South Carolina, New Mexico, Mississippi, Alabama are all big states where these communities are seen as staple housing. What are the benefits of investing in MHCs? Why do we invest in this sector? One, they're extremely high cash yields. Multifamily cap rates in the United States are somewhere between 3 and 5%. The yields for us in MHCs are somewhere between 7 and 12%. We as operators do not buy any manufactured housing communities with a walk-in yield, current yield of less than 7%. They're also extremely recession resilient. Even through the COVID pandemic and our operations of MHCs through our life, we've never seen collection rates drop below 92%, and we are at 96% right now. They're extremely low turnover. The average tenant duration is about 14 years. That is 3 times that of the multifamily apartment asset class. And the reason is they own their home and that's the last thing they will give up if they can afford it. Um, Fourth reason, it's extremely low capex from our side. In an apartment building, when I own it, if the tenant calls me because something is going wrong with their unit, I have to send someone to go fix it. In the case of manufactured housing communities, since the tenant owns the home, if something goes wrong from the toilet to the leak to whatever else, they have to fix it themselves. We don't get a call. So our maintenance capex is extremely low. As a result, our operating margins from gross rents are extremely high. We now operate a 69% net operating margin from gross rents. For most apartment buildings, that's about 35%. So extremely profitable businesses. Fifth reason, there are massive tax benefits. The average multifamily apartment building has near 30-year depreciable life. For us, it's 15 years. And I can depreciate my cost of purchase through a cost seg, about 80% of that within 15 years. And even that, I can take 50% of it in the first 5 years. So the distributed cash flows that we send out is pretty much always tax sheltered for the first 5 to 7 years. So our 8% current pay yields are more like 12% current pay yields because you're not paying any taxes on it. And finally, it's extremely fragmented market, leaves a huge potential for aggregation and to be able to sell it to an institutional organization afterwards. If you look at this slide, it'll show you how manufactured housing as a real estate investment has essentially dramatically outperformed any other asset class. So in the S&P, we've beaten the S&P 500 by 18% in 2019 and 2020. The public REITs in this sector have beaten industrial REITs, single family home REITs, data center REITs, timberland yields, and infrastructure REITs. And this is at a REIT level where they're still paying an operational cost away. By being in a private investment vehicle like ours, your returns are dramatically greater than what you're seeing in the REIT sector as well. This slide will show you that a single percentage change in the GDP has almost no impact to the actual income that comes from manufactured housing. If you look at the dark blue line, which is for single family homes, the percentage change has a dramatic shift in income sources from those type of REIT sectors, but MHCs are extremely resilient, actually more so than any other sector within the real estate asset class. And there are very, very low impacts to any shift in GDP. So if GDP falls, not a lot happens. What we think of it, because of our tenants of workforce housing, they have multiple sources of income. They have their jobs, they have voucher housing from the federal government, they have housing support from the state government and municipal government, and they also have access to other sources of income from unemployment and other benefits that always make sure their income shows up. So we laugh and joke about it. We own 8% federal treasury bonds essentially because our income does not stop coming. We talked about turnover a little bit. There's very little turnover because they own the homes, they don't move, and we can actually raise rents without reducing our occupancy. And the cost of relocating these homes are between $5,000 and $10,000. So if they can't pay me $500 a month in rent, they're sure not leaving our site with their homes. And if they do default, I can actually transfer the home to our name and have the ownership of the home within 30 days. And we can sell the home back at a secondary market and recoup about 8% or about 8 times our monthly rent. So unlike any other business, a default in our business is actually a positive line item on our balance sheet. We talked about how big this market is. The 3 public REITs combined for over $78 billion market cap. So we have tons of room to grow. The entire institutional ownership of this asset class is less than 20%. Majority of the communities are owned by mom and pop operators. And we can essentially create really good scale and fantastic exit opportunities to institutions by aggregating these mom and pop operators who do not know how to operate these assets efficiently. Who should be buying or investing in manufactured housing? Retirees. Why? If you're living on fixed income and you need yield on your income, there's nothing better than safe, secured yields than owning manufactured housing. Second, benefit and pension plans that need to essentially fulfill their obligations that are fixed for the participants. Again, I can offer you 8% fixed yields that are current paid and upside to the operations and asset ownership. Great for you. Insurance companies, you have to pay a fixed dividend yield on your insurance policies to your policyholders. We can beat that for you. Foundations and endowments. Again, you have a long-term portfolio that has a long-term yield requirement because of your duration, which is perpetual. We can offer that for you and match those yields. Family offices looking for diversification that are yield-based, but yet asset-backed. It's a covered land play as far as you guys are concerned. We should be a class that you're looking at for investments. And taxable entities, because of the high depreciation benefits and the passive losses that we can create for you to shelter your gains. You should be looking at us as well. We talked about some of these things as a result of what we are looking at. So now, why us? We've been doing this since 2016. We only focus on mom and pop operators. We're not fighting with institutions. We buy communities that range from 50 to 150 home sites. We are buying 8% plus cap rates. We are looking for extreme bandwidths and gaps to take risks. So we have to be getting paid a whole lot to take risk. We are buying communities that we can essentially aggregate and sell to institutions who have much lower cost of capital. We are giving ourselves multiple ways to exit these assets, and we own over 23 communities and over 1,300 home sites, and we've never had less than 4% tenant turnover and never had default rates more than 5% ever in our operating portfolio. And as we've said, we've seen it all in the space, and our investors can vouch for us never missing a quarterly payment, which I don't think anyone has not done, even in COVID. And we are proud of our performance and our operating history, and we are more than happy to have anyone with us as our investors. Here are some highlights on our operating improvements since the day of our acquisition. Within a 3-year period, so January 2018 through 2021 in our last fund, we increased lot rent by 20%. We increased our utility reimbursement rates from tenants by 48%. We increased the gross operating income at the park by 26.5%. We reduced the park's management fees by nearly 40%. We reduced our maintenance and repair costs at the park level, the community level, by 12%. We reduced gross expenses by 3%. And overall, we saw our net operating incomes increase by nearly 40%, which is essentially something that we are extremely proud of. It's allowed us to refinance our portfolios multiple times over and return a lot of cash to our investors back in higher fixed yields and also in recaptured equity that we can 1031 exchange without paying taxes into additional properties as well. This is our current track record. We own at purchase value $48 million worth of assets, 1,289 home sites with 20 communities. We've taken the occupancy from acquisition at 73, call it 74% to 92%. And we are excited about what we're doing in this new fund. We already have 8 properties under contract, $26 million deployed within 90 days. We have $22 million coming in off the $50 million that we're trying to raise from our existing investors. That's nearly 98% reinvestment record from our existing investors that we are proud of and proud of their backing. and hope we can do the same for you. These are where we own our current communities: Oregon, Michigan, West Virginia, North Carolina, Florida. But our focus now will be Georgia, South Carolina, North Carolina, Florida, and Tennessee. And that's where we have our 8 communities under contract. This is the team: myself, co-founder of the group, my partner, Austin Burke, who operates the property management, and my third partner, Raghav Sapra, who operates the operating functions of our company, from HR, service relationships, vendor relationships, financing relationships. We also have 23 site managers and 2 asset managers and property managers that oversee all our portfolio. A little bit about the investment details. Fund 3, $50 million. We have 3 share classes: one that paid out 8% current yield on a quarterly basis, one that does not have a pref yield but splits the profits, and one has a junior pref yield because we allow a smaller investment amount. We return the principal first. Any gains beyond principal is split according to those share classes. And again, we pay the pref yield first, and then any yield beyond the pref yield is split based on the share classes as well. For any questions and comments, please feel free to reach out. We are always available. Our contact information is included here. And thank you so much for your time today. We look forward to your joining us and investing with us. Again, thank you.